And the most liquid item is the U.S. Treasury, it's shorter than 1 year. So that puts in a bid for the dollar. Then the other liquid item is gold. So that puts in a bid for gold. And what you want to have is the price of gold going while holding as the cost of mining fall. And as I say, we use the CRB as a proxy for gold mining costs. And recently here, that gold divided by CRB hit new highs, as one would expect, maybe even a little overbought. But the trend is there, Kerry, and the trend is your friend.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. We're the second to last day of July. The markets have tended to fluctuate, to put it mildly, but gold is still in that $2,400 range. They managed to knock silver down below 30, but wanted to get an update from Bob Hoye, who has forgotten way more than I'll ever know about the sector, that's for sure. And stay tuned, because at the end, we'll have an offer so you can get Bob's latest, greatest list of miners that are poised to really explode upward when the next phase of the metals bull market is upon us, which will be sooner rather than later. Bob, it's great to have you back on the show. How you doing?
Doing great, thanks. And my colleague, Ross Clark, the technical guy, he does the dollar particle, right? But what I've learned is that you want to use the real price of gold, and that's as deflated by the, inflation, the CPI index. And the reason why I did that is that decades ago when I did the historical work, there were long periods when England was on a gold standard, so there was no change in the nominal price. But then over the long period, hundreds of years, the real price of gold changed. And particularly interesting following a great financial bubble, of which we have been in. Mm-hmm. And one of the features of a post-bubble contraction has been gold's real price going up as deflated by inflation. And it has been. Mm-hmm. But then last year in the summer, I thought, well, why mess around with that? Because they only publish a CPI once a month. So we then did gold divided by the CRB, the very popular commodities index. So what I assumed was that the CRB index was a proxy for mining costs. And this is easier to point out when you say, okay, now energy is a huge cost of mining, and crude oil is the proxy for energy prices. And what's happened in the last 7 months is that, for example, crude oil has fallen in half relative to gold. Mm-hmm. So then that portion of mining costs have been beneficial to the sector. But I'm very happy to stay with the fact that the CRB is probably a good proxy for mining costs as you get, and it is up something like 40% since the turn of the year. So that is quietly helping all miners, anybody who's producing.
All right. So that's helping the costs a lot and making these things potentially way more profitable, right?
Yeah. Now, here's a point out an absurdity, is that if people are enthused about gold stocks because the dollar is going to get crashed and what happens if in this inflationary world and dollar crashing, if the price of energy for mining gold goes up faster than the price of gold? You're not making money.
Right.
So the whole point, and now the reason why this works in the past is that with the great financial boom, you've got all kinds of bonds and debt, junk bonds, and all issued, due and payable, essentially large part of it into the financial center in New York, and due and payable in dollars. So one of the features of a post-bubble world is a chronically firm senior currency. It used to be sterling, and when London was the financial center, now it's the dollar, and New York is the financial center. So, but then, as all of the froth of the debt bubble collapses, that is a huge loss of liquidity. But Mother Nature's got a way of increasing liquidity in the banking system. She moves up the real price of gold. The miners make more of it, produce more of it, and then it gets into the banking system from the bottom, starts to rebuild liquidity. So as I point out, a typical post-bubble depression has lasted for about 20 years with the 3 to 4 year business cycle coming and going. The recessions are more severe than the recoveries. And as a matter of fact, in the literature, the first use of the word Great Depression, well, it came in the early 1880s when that bubble had peaked in 1873, and British England then was the senior economy, and British economists couldn't figure out the prolonged weakness. And then they said, oh, it's a Great Depression, and that's the first mention in the literature that I stumbled on of that term, the Great Depression. And then, of course, that Great Depression ended in 1895, and then you had the whole recovery, such that 1920 was the high for commodities, and 1929 was the high for the bubble, and then crashing all over again. So, yeah, Mother Nature's quite brutal that way, but if you've got the game plan, it helps a whole lot. So our view is for investors to be, fully invested in gold stocks. They could correct. Recent enthusiasm was quite noticeable. Mm-hmm. And the big stock market, the S&P, could get hit in the fall. So we wouldn't chase gold stocks, but we would look to repurchase selling pressures, say, in October sometime. So, but the main thing is that as the rest of industry does and the economy does poorly, the gold mining side does very well, like in the 1930s or the 1880s, that does well. So you're going to have fund managers out there, the more aggressive equity fund manager guys. They're going to look at a couple of quarters where the GDX or GDXJ, gold index, is noticeably outperforming the S&P. So what that means is that, Kerry, that the equity fund managers who would not normally look at gold, they're going to say, hey, it's a good sector, I got to get in. So there's a possibility of a new kind of player coming in. So this is why I'm very bullish for the longer term on the whole breadth of the gold stocks, and particularly like junior exploration. That's, it was 1996 when we got a list of 5 junior exploration stocks, and one of them turned out to be, we were looking for a good exploration market, and one of them turned out to be Arequipa, which went to $30. Rather nice. So we now have our list of 11 small cap gold stocks. They seem to have based, and what you get with this is that potentially when they turn up, you're going to get much better percent gains than, say, in the senior gold stocks, unless you leverage, and don't care for leverage much. So we've been advising, accumulating our list of 11 juniors. And on one of them I'm particularly interested in. It's been not been drilling, but it is now about to start drilling. So that's a plus for one of them. But and if anybody's interested in our list of juniors, we'd be pleased to send it to them. And also with the provisions that one or two may just get stuck, but within 11 or 12 of them, there could be some good winners.
All right. Well, hey, one good winner can make up for a lot of losers, right?
Well, as I said, that Eric Weepa was the one that worked for us, and that was a long time ago.
So,
and any penny stock that goes to $30, you're going to kind of like it or remember the experience, won't you?
Oh, yeah. Yeah, we need a few more of them, though. We need some more of them, Bob. So.
Yeah. Well, I think our list is pretty good coverage. There's the small producers there's small pre-production, and then there's some just straight exploration stocks. And one of them, which we can talk about separately, is it is just starting to drill.
Mm-hmm.
On what could be another Witwatersrand geology. Now, Witwatersrand geology is in South Africa, and that's the system that hosts all of that gold mining. And the accepted number, Kerry, is that Wit has produced some 40% of all of the gold ever mined in history. And it's still, even today, and that's from 1890 production.
Mm-hmm.
And still today, it's got one of the outstanding reserves in the world. So a Witwatersrand gold system runs forever, you can say. So once on this stock, as I say, we're just starting to drill now, and we soon should get out of the H listing and onto the net, whatever they call it. There could be a good run in the stock. On two things. One, getting up on the recognized listing, and two, actually getting results out of the field. So, they can get in touch with me. Listeners can get in touch.
Or just send
me the name.
Yeah, they can just send me an email, kl@kerrylutz.com, and say Bob's Stocks or Bob's Picks in the subject line, and I will forward you the link.
That's great, because Ross, my colleague, has set up a system for responding with this, so
great,
keeping track of it all. So we're really set for it. Yeah.
Excellent. So just send that email, and we will take care of the rest for you. So as far as looking ahead, so you still believe that belief that the dollar is going to go to oblivion is the dollar's death is greatly exaggerated, huh?
Yes. That was my news of the dollar's death has been greatly exaggerated. Now, let me give you, I hinted at it a little while ago. In a great bubble, the stock market gets the attention, but also the bubble is in debt to it. Debt bubble like you wouldn't believe. Now, once the party is over, that debt is due and payable in U.S. dollars into New York. And all you have to do is to have 60% or 70% of all the debt bubble due and payable in New York, and just servicing that debt into New York is a huge bid for the dollar. But also, you have investors around the world, the very careful investors, and in a storm, they will go to just the most liquid items. Return doesn't matter. And the most liquid item is the U.S. Treasury, it's shorter than 1 year. So that puts in a bid for the dollar. Then the other liquid item is gold. So that puts in a bid for gold. And what you want to have is the price of gold going while holding as the cost of mining fall. And as I say, we use the CRB as a proxy for gold mining costs. And recently here, that gold divided by CRB hit new highs, as one would expect, maybe even a little overbought. But the trend is there, Kerry, and the trend is your friend. And the sector, if gold sector is on a long bull market, and there will be times when it becomes fabulous with a potential world-scale discovery. And that's one of the ones you want to have in a suite, say, of 11 or 12 gold stocks, like Arequipa, one that could become, very rewarding.
Yeah. All right. So what about all the debt? We're always worrying about all the debt. Does it just disappear? What happens to it?
It ends up being massive losses to the whole global economy, because you're going to have junk bonds down to no bid, and defaulting. So then you don't want to own high yield bonds. Now, the other thing is, because the liquidity disappearance can be such that you don't want to own long treasuries either. But if you're in deposits or short, like 3-month bills, those 3-month treasury bills are going to go back down to 0% again, and the Fed funds will follow.
Mm-hmm.
So the happy point could be, say, 3 to 4 year term, good corporate bonds. You'll get a hell of a lot better return than from T-bill or deposit type stuff. And at a 4-year term, you're not going to get whacked too much by price. I really like it for fixed income investors. It's the 3 to 4 year good grade corporate bonds. And if you go to a full brokerage dealer, they will probably have a bond desk where they can give you a fill on those bonds. And whereas if you send T-bills, it's going to go to zero. The Fed funds, here they're now talking, Kerry, about Fed cuts.
What's going to be with that?
Look, it's a disaster. Fed cuts are a disaster. And I'll explain it is because in a boom, and I've got the figures even back to 500 BC, interest rates go up in a boom, and they go down in the bust.
Right.
So the current buzz is that interest Fed's going to cut, and that'll get the party going. That is dead wrong. And there was a guy with Harris Trust in September of 2007, and I got his quote written somewhere here, but I've used it lately. Is that he says it's absolutely certain that the Fed cuts will help the stock market. Well, the stock market peaked in the middle of that October. The economy peaked that December. And we went into this 08-09 bear market, which was very severe. So the point being, and also we did a chart, and I'm updating the study now, and you take a chart of the S&P against the 3-month treasury bill, and not only do they fall together, but on the fastest plunges for the T-bill rate are associated with the fastest plunges in the S&P.
Really?
So they're talking up and they're excited about the Fed cut, and Fed cuts will be a disaster.
Hell. What's going to... So that's going to cause the market to collapse? Is that what you're saying here?
No, it is a cyclical beast, and it became... Now, here's the way we look at it. It's seasonally, May and June of the year can be very good for stock prices. And as a matter of fact, of the 5 great financial bubbles, since the South Sea bubble in 1720, the peaks were in May, and actually in London, the South Sea bubble peaked in that June. So, hey, there's empirical stuff behind this. So what you want to do is in June and July, which was what we've been doing, is if the action was not overbought, you're in a rising trend of a bull market. But the action, it rang all our bells and whistles. It had momentum, it had sequentials, it had all kinds of things. on a probable seasonal high. So the first would be a loss of momentum. We've had that. Then the next hit would take out a correction on the way up, and that's happened. So I think the stock market is going to dither around through August, and then typically, if you're going to have a financial disaster, it'll more than likely be discovered in the fall. So our advice is to take money off the table in long bonds, avoid junk as best you can. Just don't go there, and raise liquidity from your equity portfolio.
Sure.
In a hard times, liquidity gets to be very important.
Yeah. Well, liquidity isn't important until it becomes important, right?
I think somebody important said something about that. Hemingway's description of going broke.
Yeah, going broke, right.
Oh, and then it was very fast or something like that.
Well, it's like bank runs. As long as people believe that they can get their money from their bank, they're happy to leave it there. But the second they believe, or you believe, that your bank is going to hit the skids, you'll be lined up around the block. Now, obviously, in the West, we've done away with bank runs because you're not going to get cash. All you're going to get is a check to bring to another too-big-to-fail bank. And what does that do, right? You got like nada. So you get nothing from that, right? But
well, I remember ages ago running into a cartoon in the 1720 bubble. When it crashed, it left a lot of people broke, and that's where the term lame duck came in. And Daniel Defoe, the writer who wrote Robinson Crusoe, there's a note by him where in the South Sea crash, he lost 19,000 pounds or something like that.
That was like $1 million back then.
Funny. And then he laments that how many times, 10 times I've been rich and 10 times I've been poor. I don't seem to learn.
I can relate to that one. I'll tell you, I've been rich and I've been poor, and rich is better. All right. If you want the list of the stocks, his top mining picks, send an email to kl@kerrylutz.com. The list has changed a little bit from last time. Make sure you go over to our site, financialsurvivalnetwork.com. Sign up for your free newsletter. Bob, always a pleasure. Thanks for stopping by.
I'm glad we got together, Kerry, and look forward to the next time.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.